Hello and welcome back to the channel. Today's video is on gold, which at the time of recording has broken through the historic $4,000 per ounce mark. You might be able to tell by the grin on my face that my prediction outlined in my previous video when gold reached 3,000 back in March has played out, where I did mention that I do see the bull cycle continuing. Admittedly, it's progressed perhaps a bit quicker than I was expecting, and the bull market has moved at a ferocious pace. In this video, I'll break down why gold has more than doubled in the past 2 years, whether it's too late to get invested, and why this isn't a new paradigm, rather a return to historic norms. Let's start firstly with how gold has performed in numbers. Since my video back in March, gold has risen from 3,000 to 4,000, so a 33% rise, and is up 50% year to date, which is on track to be its best performing year since 1979. And over the past 24 months, it's risen an incredible 118%. These are the kind of moves you'd normally expect from a tech stock or a cryptocurrency, not from a precious metal. Taking a look at what's driving this, why gold has reached these nosebleed levels. Firstly, let's cover the fundamentals first. I promise this will be the last time I smugly reference that earlier video, but if you still think gold is just a shiny rock or a piece of jewelry, I do recommend giving it a watch. I laid out in that video why gold has been the bedrock of nearly every functioning monetary system in human history. But to recap on the themes explored in that video, since 1971, we've lived in a fiat-based world. That's when the US dollar and every major currency alongside it was taken off the gold standard. That shift gave central banks globally the freedom to expand their money supply at will through what we now know as quantitative easing. In simple terms, money can in theory be printed to infinity with non-gold standard fiat currency system, and with every new dollar printed, the value of every other dollar falls. There have been many instances where this system's failed. Just to give you a few examples, we can look at Argentina and Zimbabwe. That's just in recent memory, but probably the most famous example was the Weimar Republic, which was a precursor to an Austrian painter rising to power. In those cases, excessive money printing destroyed trust in paper currency, and each time gold reasserted itself as real money. We can draw, it's probably not as extreme in this instance, but we can draw clear parallels between those periods I mentioned and the present. Since COVID, central banks, particularly the Federal Reserve, have expanded the money supply exponentially, eroding the value of the dollar, and other central banks have eroded the value of their native currency as well. Combining that with America's $37 trillion of debt, their widening deficits, sticky inflation, and a renewed wave of isolationist policy by Trump, you have a clear picture of what's driving the collapse in the confidence in the dollar. With the alternative choice being gold. This trend I mentioned has accelerated dramatically over the past few years. In 2023 and 2024, central banks were stockpiling gold at record levels, especially in US nations such as Russia and China. Under Trump's America First stance, many central banks around the world have now shifted a greater share of their reserves into gold rather than US treasuries. And that's been the first time since the 1990s. And just before I do receive accusations that I've got an agenda against Trump, may I just mention that Biden, when the Russia-Ukraine war first started, Biden weaponized the dollar, which in my opinion started this trend, and Trump has accelerated it. So all of this is a huge signal. The world's monetary authorities, who collectively hold trillions, are quietly preparing for a world less dependent on the dollar and are re-establishing gold as a neutral reserve asset. Now, for you as an investor, with central banks being responsible for the price doubling over the last 2 years, is it too late to get in, or are we still in the embryonic stages of this cycle? From my perspective, it's certainly not too late. While there might be a correction looming, given the steep ascent, there's still room left for significant gains in this cycle, and even a slim chance this becomes a super cycle, meaning sustained growth over decades rather than years. The reason I still think there's more in the tank for gold is because this rally has been sustainable, unlike other rallies which can often be built on the weak foundation of speculation. This one's a little bit different in my opinion because it's been driven by what I would label as super smart money, which is central banks and sovereign funds. And I'd go as far as making the case that the smart money, typically institutional investors, hedge funds and asset managers, and of course the speculators, have not even begun to enter yet. To qualify that statement, just taking a look at how underallocated smart money truly is. Bank of America conducted a survey across 200 institutional fund managers who collectively oversee around $500 billion. The average allocation to gold was just 2.3%. And around 40% of those funds hold zero gold at all. So they're in a position of having to play catch up. Just scaling that out globally, professionally managed assets exceeds 100 trillion. So even a small shift from a 2.3 allocation to a modest 5% allocation would move mountains for the gold price. On the retail side, last month we saw near record inflows into gold ETFs, at a pace which has not been seen for a number of years now, indicating that retail investors are finally moving from the sidelines and starting to participate in this move. And I will be getting asked the question quite often, this all sounds great, but please give me a price target. And for me saying this, I might get a strongly worded email from my compliance department, but I don't believe 6,000 per ounce is out of reach over the next 2 to 4 years. I'm expecting at least one significant correction along the way, but I believe it will ultimately reach or may even exceed that level. And from an investment perspective, how much should you allocate to gold within your portfolio? Well, quite recently, Morgan Stanley's chief investment officer proposed replacing the traditional 60-40 portfolio with a 60-20-20 portfolio, being 60% equities, 20% bonds, and 20% gold. And Ray Dalio has suggested around a 15% allocation to gold. Probably the most fun allocation is the Turkish portfolio, which is 50% equities and 50% gold. I've got one client who's done that on his own volition, but I do not recommend this on this video. And just putting my financial advisor hat on, it really does depend on your goals, your risk appetite and circumstances, and gold should always form part of a diversified portfolio. With that said, my clients and I have had a relatively high conviction position in gold for a number of years now. That looks very different depending on the individual, but for those who are watching this video with zero exposure, I implore you to at least consider having a small percentage in gold, at very least as a hedge against inflation, geopolitical uncertainty, and the growing cracks in the monetary system. And who knows, that hedge might just become the best performing asset in your portfolio. Thanks for watching, and I will see you on the next one.